Think like a market maker, understanding implied volatility. An option trader who focuses on volatility trading will tell you that the price of volatility is the single most important factor in trading volatility. That might sound intuitive to us, but it wasn't too long ago when implied volatility was merely a plug number when we wanted to price an option, or just another one of the six-factor model we all know as the Black-Scholes option pricing model. Ever since I joined the market, I have been fascinated by the idea of implied volatility. How can we accurately forecast future volatility? Should we use historical pricing dynamics to predict future dynamics? How do we account for future events when we use historical volatility? All of these questions push me to try to understand the nitty-gritty of how market makers price volatility. It took me many years of trials and errors in attempts to reverse engineering price and endless discussions with sell-side traders and quants to learn how market makers view implied volatilities. When we price implied volatilities, we can think of its building blocks or weights that we add to our base volatility, which is our best estimation guess of the future realized volatility. Let's first define the different factors that affect the pricing of implied volatility. Liquidity, the weekend effect, seasonality, economic earnings calendar, hedging flows. Now that we understand which factors go into the volatility pricing, let's dive into each aspect. Liquidity. Most of us take liquidity for granted. We pay little to no attention to this factor, mainly because the trade sizes that we execute normally aren't a fraction of the availability liquidity of the market we trade at any given point of time. Let's say we want to trade 20 E-mini contracts, 10 mini Euro USDs. These trades will hardly move the markets because of the depth of these markets. For market makers and large investors, hedge funds, institution investors, etc., liquidity means the ability to carry on their day-to-day trading activity with minimum transaction costs and market impact. When a market maker runs an option books, liquidity plays a major role in the volatility price setting, as the dealer needs to continuously hedge the delta risk, needs spot liquidity, and occasionally unwind options, either in the market or at the interbank brokers. These different liquidity needs will be factored in when the dealer quotes implied volatility. The more liquid the asset, the tighter the bid-ask volatility is. Furthermore, the more liquid the asset is, the lower the weight of the dealer will add to this base volatility. To emphasize the liquidity-volatility relationship, let's look at the bid-ask spread, volume scattered against the implied volatility itself. If we assume that the change in the bid-ask spread represents the level of liquidity or liquidity conditions, we can definitely infer that's correlated to the change in implied volatility. The weekend effect, aka weekend premium. Weekends and non-trading days have meaningful effect on implied volatility pricing. As options are priced using calendar days, 365 days a year, we need to account for non-trading days, as there are roughly 250 trading days a year on average. The mismatch between calendar days, trading days has two notable effects: implied volatility discount over weekends, holidays, price discounted over weekend gap. Implied volatility discount. When we price short-dated options, let's take for example a Monday expiration date on Friday afternoon, we need to account for the fact that despite the option being T days option, we have T days of zero volatility, where T is the number of net trading days. So effectively our volume should be. Let's look at numerical example. It's a Friday and we want to sell an option that expires on Monday to collect decay over the weekend. Yesterday, Thursday, the implied overnight volatility was 16. We ask our broker for a quote on the 3-day option and we get quoted at 9.5 volume. At the start, it looks as if our broker is trying to rip us off. Yesterday, the on volume was 16 and today is 9.5. But we understand the weekend effect. We can actually see that the fair quote would have been 9.25, but the dealer has added some risk premium. We will touch on that later. Now, we don't want to sell such a low volume. We want to have a chunk of volatility premium, so we decided to sell 1 week options expiration next Friday and maybe close on Monday after collecting the premium. We again ask our broker for a quote and we get quoted 14 volume. This looks to us like a better deal, so we sell the option hoping nothing will happen over the weekend so we can close it first thing Monday morning. Following Monday, we ask our broker for a quote on the remainder of the 4-day option, but now we get quoted at 16.8 volume. After expressing our dissatisfaction that nothing happened over the weekend, but the price got bumped, our broker calmly says. When you sold 1 week option at 14, the first 3 days were priced at 9.25. So your forward volume implies 16.6. So I just marked it 0.02 volume higher. This example is crucial in understanding the concept of forward volatility or volatility term structure. Given that we know the term structure, shape, and levels, we can calculate at T0 the forward implied volatility for any point along with the term structure. Generally speaking, we can use the following formula to calculate the forward implied volatility. So we see that the deal is discount non-trading volumes when the price options and volatility, but non-trading days impose another issue, which is price discontinuity and gap risk at the open the following trading days. As we know, a lot can happen in 48 hours, so obviously one cannot ignore when pricing volatility and should weigh some likelihood of a gap at the open. Historically speaking, gap risk is priced at a premium, very much like volatility risk. Historically speaking, selling the gap risk tends to be systematically profitable strategy, as there are rarely gaps over the weekends, or at least on a close-to-close basis, but they have been very few tall events over the last 10 years. The weekend effect and the gap up risk following the weekend are structural premiums that the option market uses to account for non-trading days and discountly in price action where traders cannot react in real time to new information. Seasonality. Volatility, like most other statistical measures, tend to exhibit seasonality patterns. Part of the seasonality can be attributed to market misstructures and hedging flows related to known cycles in financial markets. Just think about the spiders and the VIX expiration cycles and the effect on implied volatility and realized XPX volatility. Other factors that can affect seasonality and implied volatility are forecasted season with heightened depressed volatility, earnings seasons, and summertime come to mind when thinking about cycles of realized volatility. If we take a look at USD ZAR, for example, we can definitely spot a strong negative seasonality for implied 1 month volume over the month, where applied volatility tends to sell off into the summertime. Obviously, we should ask ourselves whether the negative seasonality implied is justifiable, or in other words, is selling a 1 month volume into summertime in USD ZR a profitable trade. Let's examine this strategy using theoretical short volume swap position of average 1 month volume in July compared to the average realized volume in August. We can see that the realized volume in August tends to outperform the implied 1 month in July. On the other hand, if we examine relative or USD ZAR compared to USD MXN, we can see that seasonality implied volatility translate into lower realized volatility the following month, which makes the selling volume into the summertime strategy a profitable strategy. Now, obviously, the strategies here are a bit biased, as we assume the volume swap we traded represents the average 1 month volume in July and was closed against the average realized 1 month volume in August. Still, we can definitely see the seasonality weighing in USD ZAR is far from being realized in the realized volatility the following month. Economic earnings calendar. The economics earning calendar is probably the key factor in pricing implied volatility. Assuming that volatility and noise in price action is a function of new information received by the market players and the reaction of functions to the degree of data surprise, one can understand why it's crucial for traders to be familiar with the economic data earnings calendar. Before we dive into the nitty-gritty of echo data analysis, we should acknowledge that not all data releases are created equal, and some data releases have more meaningful impact on the markets than others. Also, the reaction function to data release is highly dependent on the market narrative, which makes historical data analysis not as straightforward as one might expect. Calculating the event weights can be done in many ways, and each trader has their own way to analyze the weights, but the general idea is pretty simple. Rank the different economic releases by importance. For me, monetary policy related events like CPI, labor market, and CB meetings are the most important, followed by growth data like GDP and retail sales, and economic activity, PMIs. Calculate the historical weights for the event's volatility. That can be done using a ratio between the one-day volatility or the average between the one-day OHLC volatility and the one-day volatility the next day as the market digests the data. And the realized volume, the reference period prior to the date release, can be either 1 week, 2 week realized volume, example the event. One can use conditional volatility to better estimate the probability distribution given upward and downward pressure. Apply the weighted average minus average event weight for each event to future economic calendar. Let's run this analysis to estimate the event weight of a US CPI for USD JPY volatility. First, let's plot the distribution of events weight as produced using the above methodology. As one can see, on average, events had volume seasonality of about 2x the realized volume of prior 1 week, which means that the based on historical data CPI days tend to be more volatile than non-CPI days. Now we want to assess the conditional volatility giving upward, downward economic data surprise, and we have no clue prior to release whether the data will beat or miss the market expectations. As we can see in the right chart, we should expect above average realized volatility compared to the relative upward bias realized volatility on CPI days, both from a downward and upward surprise, although a downward data surprise tends to produce more volatility. If we compare that to implied overnight volatility for CPI days, we can clearly see that the market makers assign about 2.2 volatility over the CPI event, which aligns with historical CPI events. Hedging flows. The last piece of implied volatility puzzle is probably the hardest to gauge, yet touches on a very basic of derivative trading and options specific, and that's the usage of hedging instruments, as options among other derivatives are used as insurance for large portfolios of different underlying, from stocks and bonds to commodities and currencies. Their value reflects some degree of risk premium. Hedging flows control all three aspects of the volatility surface. The level of the front-end ATM volatility level related to realized volatility, the shape of the volatility term structure, the shape of the volatility smile, skew, implied risk neutral probability density. ATM Volatility Level. The ATM Volatility Level is the mostly used to gauge the volatility risk premium, or other words, the excessive premium option sells demand the options. The question we need to ask ourselves is excessive premium related to what? Most practitioners will compare the implied volatility for period T to the same length of historical volatility window, for example, implied 1 month volume to realized of the last 1 month. This inherently means that we assume the future underlying dynamic will be similar to historical realized price dynamic. Historically speaking, implied volatility tends to trade at premium to the future realized volume, which is why short volume gamma is systematically a profitability trade strategy. To examine this hypothesis, we will run the following backtested strategy. Short 1, month volume swap on different asset classes proxies, a multiple asset portfolio rolled monthly. As we can see below, even the negative performance February-March 2020, the strategy was profitable over the last 10 years. If we dive deeper into the data, we can definitely see the March 2020 marked change in the correlation regime between the different asset classes. Obviously, many multiple assets volume funds, which were a significant driving force in the volatility space, got liquidated and washed out, contributing to decorrelation in implied volatilities across the different asset classes. For the volatility term structure, after understanding the flow's impact on the front-end volatility risk premium, we should understand how the hedging flows affect the shape of the volatility term structure. Generally speaking, the shape of volatility term structure reflects the implied volatility mean reversion tendency, i.e. the long-dated volatility less affected by the short-term price dynamic, and is driven both by hedging flows by large institutional investors that protect their long carry investments with option buying programs, and by flows from structured products, mostly yield enhanced, that are packaged as note with embedded optionality. The shape of the volatility skew smile. The implied volatility skew smile has in the Center Derivatives Research since the late 70s, early 80s, when practitioners questioned the validity of the Black-Scholes flat volatility across strikes maturities assumptions was introduced in their Nobel Prize-winning options pricing formula. Before we try to understand why volatility skew exists, let's first understand the idea behind the notion of volatility skew. In the naive Black-Scholes volatility universe, we assume a bell-shaped like probability density. This means basically that our risk-neutral probability assumes a normal distribution of further outcomes. When we apply the skew, assuming the higher volume for one side over the other, our risk-neutral probability would become conditional on the levels of spot strike. Does it mean that we really think the spot has a greater chance of going up or down? Not necessarily, but investors, dealers, market makers will be willing to demand an additional premium for the OTM. Does the volatility skew exist? We can give many reasons why the volatility level is not constant across different strikes. The volatility skew smile shape is mostly driven by hedging flows and market perception regarding the convergence of a spot volume. In the equity space, for example, volatility of downside strikes in the indices like SPX priced at a premium relative to the equivalent call money, for example, 5% OTM put compared to 5% OTM call. As large institutional investors like pension endowment funds are naturally biased toward long equities as it carries on a long horizon, good risk-adjusted returns, they are willing to pay an extra premium to protect their books against equities downturn or engage in call overriding strategies in which they hold underlying assets and sell calls to collect premiums. In both strategies, the premium for the call comes under pressure while puts maintaining a premium over ATM model to evaluate implied volatility. A toy model to evaluate implied volatility. So far we've seen various factors that affect pricing implied volatility, as we would like to have the ability to assess whether the current pricing of implied volatility for a specific maturity is rich, cheap. We would like ideally to make a simple model that generates the fair implied volatility for a given maturity. When we value the implied volatility, we need a few parameters. The average clean realized volume of the recent 9th day. By clean, I realize the volume of days that had no scheduled economic events. We can use a combination of intraday high frequencies close volume to get the average volume. The scheduled data releases and their calculated weights, for example, if we have in our future term 2 CPI releases and currently we value the weight as 2, we will assign the CPI a factor of 4 is the number of events, W is the weight. The seasonality factor for the expiration month of the year. The liquidity factor. The more liquid are underlying, the lower the factor IRL. The liquidity will also affect the bid-ask spread the market maker will apply to mid-volatility. The number of calendar days, not business days, in our term. If we put it all together, we can generally arrive at a following formula. Note, we are dividing our weighted variance by the calendar days to account for non-trading days, i.e. weekend effect. Obviously, a few parameters here are widely unknown. The base realized volume to which we apply the different weights and the different event weights. Still, many attempts to reverse engineer quoted prices yielded a very similar formula where the length of the base volatility is roughly half the implied period. For example, using 2 weeks clean realized volume to arrive at implied 1 month. I hope my attempt to shed some light on how dealers, market makers calculate and make volatility prices managed to give you some clues about the different factors that play a role in the pricing process. As always, feel free to share your thoughts and feedback.